and welcome to everyone to this program. I'm happy to be back with Howard Marks, who has been dispensing wisdom not only to the investing world, but specifically to Asia Society Southern California since the start of the pandemic. Howard is the co-chairman of Oaktree Capital Management and a renowned investor who thinks long-term, as you will see today. Also pleased to welcome Ida Liu, who is the global head of Citi Private Bank, which, as you probably know, is all over the world. I think 50 offices. And Ida is also, among her other many accomplishments, is a trustee of Asia Society. So welcome to you both, and thank you for being here. We have a large audience that's tuning in from around the world, so they will hang on your every word. Ida, I'd like to start with you. So as head of a private bank that has sophisticated investors all over the world, what sort of framework are you and the bank kind of giving them to think about the year ahead?
Well, firstly, Jonathan, thank you so much for having me. It's an absolute pleasure to be on with you and Howard today. What I can say is that investors in this last year have been through one of the most challenging periods in recent history. In fact, one of the most challenging years in the last 14 years since the financial crisis. When you think about the fact that global markets took a $30 trillion hit, global equities were down 20%, global fixed income was down 16%, coupled with the fact that we had 7 rate hikes, we had inflation at 40-year highs in June last year, above 9%, and we had a war happening in Ukraine. So that and the continued pressures and zero COVID lockdown in China made it a very, very challenging environment for investors globally. So we did 4 things for investors at the start of last year, and that economic outlook is very different now where we sit at the beginning of this year. But the 4 things we did last year was, 1, we hedged both the asset and the liability side for our clients. So as you can imagine, at the start of the year when rates were still low, we locked in a lot of low fixed rate debt obligations for our clients. We also hedged on the equity side. We pivoted a lot of cash positions into enhanced yield opportunities, such as fixed income, which is still something we're doing very proactively today. When you look at all the opportunities that we see in the fixed income side of the world, we pivoted the equity positions to very high quality, dividend paying stocks, some defensive stocks, which I can share more with you later. And then lastly, we added more private equity, alternative and hedge fund exposure to our clients' portfolios, given the attractive valuations that private equity managers were able to attract in this kind of market dislocation. So we did that, and here we are at the beginning of this year, and the outlook is looking very different. Right, we just had a rate hike. We expect probably a couple more. We expect rates to reach a peak at some point this year. We expect inflation to continue to come down, hit somewhere around the 3.5% marker from 6.4% now. And China's open, right, which means opportunities for investors globally. So we've been, again, looking at huge opportunities in fixed income. You look at the that we're seeing for U.S. taxpayers in municipals. You look at the opportunities we're seeing even in treasuries, where the 6-month treasury was at 25 basis points at the start of last year. It's 5+% right now. So some interesting opportunities in fixed income bonds are definitely back. And we're looking at pivots into dividend paying stocks. And in addition to that, as I said, we're still adding alternative exposure for clients' portfolios as well.
Right. And so it's obviously a huge, you've positioned the investors, and now we have a very challenging year ahead, but you feel that you guys anticipated and made certain defensive moves ahead of this.
No, we definitely did. And as I said, fixed income is offering very attractive opportunities for investors. Look at the yields we were just talking about, high single digits for very high quality fixed income. The shift to dividend paying stocks, think stocks with very high cash flows. And when you look at dividend paying stocks as a whole, they outperform the market by 10%. and dividend-paying stocks have contributed to probably about 40% of the growth in the S&P 500 over the last 100 years. So, there's definitely elements of shifts that we've made in the clients' portfolios that have added a lot of value in today's marketplace.
So, Howard, zooming out, which you do in your memos, today's program, the title is drawn from the title of your most recent memo, Sea Change. Explain, what the sea change is, but also in the context of 50 years and, your 50 years in investing and how rare an event that this kind of sea change is.
Well, first, we should define a sea change. And to me, it is a thorough transformation in the environment, and a fundamental change, not just a short-term cyclical fluctuation like we see so many, but a real change that I think will last years. And, everybody should bear in mind the difference between a change and a fluctuation. You're very kind to me to understate my age. I actually have 54 years in the investment business since I started with Ida's employer. I've seen, I believe, two primary sea changes in that period. I joined the high yield bond business in 1978. I was lucky enough to get in on the ground floor of that. And prior to that moment, the way the investment business worked pretty much was that there were good assets and there were bad assets. And it was okay to buy good assets and it wasn't okay to buy bad assets. And it kind of didn't matter what the price was. The price didn't turn a good asset into a bad asset or vice versa. And in fact, when I started in high yield bonds in 78, Moody's defined a B-rated bond as fails to possess the characteristics of a desirable investment. In other words, taboo, not fiduciary. And what the real miracle of the high yield bond innovation was to say, all right, these are crummy companies, but is there an interest rate which is adequate to compensate for the risk and to make a bond of a crummy company a good investment? And that was a sea change, because ever since then, what we'd say in the investment business now is it risky? And does the return more than compensate for the risk? And if so, we can buy it. So that's a change. Then the next change came a few years later. We went through a very difficult period with inflation in the 1970s. Inflation got up to roughly 15%, 15%. And more importantly, nobody could think of how to stop it. They took the Fed funds rate, I think, up to 13, and that didn't do anything because it was still less than the rate of inflation. Then I think around 79, President Carter appointed Paul Volcker to the chairmanship of the Fed, and he took the Fed funds rate to 20, and that killed inflation. It also killed the economy for a while. We had a severe recession, but at that time, 1980, I had a loan outstanding from the bank, and I got a slip that said the rate on your loan is now 22 and a quarter. And 40 years later, I was able to borrow at 2 and a quarter. So rates came down 2,000 basis points. And I believe that the decline of rates is incredibly salutary in most quarters. It makes the economy strong. It makes companies more profitable. It makes assets very valuable because when people reduce the amount of return they demand on an asset, they're able to pay a higher price for it. And it makes bonds more valuable. And it also is great for borrowers because their debt service costs go down and down and down and down and down. And that's what happened for 40 years. I believe the decline of interest rates over that period was the number one event of the last 50 years in the financial markets. But because it was so gradual over such a long period of time, nobody noticed. Right. I think that the decline of interest rates is responsible for the majority of the money that was made in the last 50 years in the financial sector. So that obviously the decline was a major sea change. And as I say, great if you were a borrower, terrible if you were a lender, terrible if you were a pensioner living on a portfolio because the income went down, down, down. And so those were the two I've seen. I think we're going through a third right now. To rescue the world and the country from the global financial crisis of 08, the Fed took the Fed funds rate to zero for the first time at the beginning of 09. Interestingly, it kept it there for 7 years. Now, it's a bit of a puzzle. I believe that it's fair to say that zero interest rates are an emergency measure, but we didn't have an emergency for 7 years. Back by 2012 or 13 or 14, somewhere in there, the economy was back on a firm footing. So why keep the Fed funds rate at zero until 2016? The world got addicted to low interest rates. It continued to benefit owners of assets and borrowers. And so we had an expansion of the wealth gap because the people who owned assets made a lot of money and the people who didn't own assets didn't make any money. And so the wealth gap grew. It was, as I say, very good for borrowers and very bad for lenders or providers of capital, savers. And in this period, we had prosperity. We had the longest economic recovery in history and the longest bull market in history, both exceeded 10 years. We had very easy availability of capital at very low prices to borrowers, to highly levered companies. And if you had a low quality company that burned money every year, and if they ran out of money, they could borrow more money. And nobody minded lending money to companies that just burned money, which is an unusual occurrence. And there were very few defaults, very few bankruptcies. The prevailing fear was not the fear of losing money, it was FOMO, the fear that your competitor would do something that was very aggressive and it would work and you wouldn't have it and you would lose competitively as a result, or maybe just feel bad because your competitor or maybe your neighbor or your friend made more money than you did on his or her investments. So it was it was an easy period for asset owners, companies, managements, and borrowers, and tough for lenders and tough for bargain hunters, because in this period, the owners of assets were complacent and the people who didn't own assets, the buyers were eager. So when you have complacent owners and eager buyers, you don't get any bargains. That's not how the auction works. Challenging period for myself and for Oaktree, from October of 2012 until February of 20, I gave a speech entitled "Investing in a Low Return World," because with interest rates so low, the prospective returns on most asset classes were very low, especially debt or what we call credit. And how do you get a good return in a low return world? The answer is it's not easy. Well, I think all of this is kind of over now, because the elevation of inflation to a 40-year high made the Fed make the interest rate increases that Ida was talking about. Interest rates went way up, prices of bonds and stocks went way down, as is commensurate, and the fear of missing out on returns transmuted into fear of actually losing money. So now the holders are not so complacent and the buyers are not so eager. And so this optimism does not prevail to the same extent. And now we're in a better period for lenders and a less good period for borrowers. I think obviously, as demonstrated by the events of last year, a less good period for owning assets and a better climate for buying assets at bargain prices. So, and I think the bottom line, Jonathan, is that with interest rates having gone down 2,000 basis points or 20 percentage points in the last 43 years, they're not going I don't think they're going back up, but there's no more room for them to go down. So now I think we're going to be in essentially, not to the penny, but essentially a steady interest rate environment in which asset owners and borrowers will not have that tailwind. And I think that the strategies that work best in that abnormally easy money period of 09 through 21, those strategies may not be the best strategies for the years ahead, and especially their advantages will, even if they persist, will be trimmed. So I think that's my third sea change.
Right, and I want to go into the rate question a little more too, but let me ask you something, because you said that because the rates were lowered over such a long time, people didn't notice those as the biggest, in your opinion, the biggest factor in creating all that prosperity. So is the converse true now, or the inverse true now? Will rates be the predominant factor in lower investment return expectations?
If rates go up, then the rate of return that everybody wants to make goes up. And the way prospective returns go up is through a reduction in the price, primarily. And we saw a bunch of that last year. There was a furious rally from late November through January, which took about it almost halved the decline. But I think that if rates, right now there's optimism that the inflation will abate, the Fed will not have to continue raising rates, and the recession that rising rates normally produces will be averted. That's the optimistic case. That's the case that won for the last 10 weeks. But I think if that case is disproved, which is my personal guess, then prices of assets will have to go down so that the assets provide the higher prospective returns that people will demand in a higher interest rate environment.
Right. Ida,
all these things are kind of complex, and I apologize for the belaboring the complexity of my explanations, but it's really indispensable.
No, that's true, and these are complex, and there are no simple answers, no silver bullets to people who are obviously very worried about their investments. Ida, you've talked in recent months about the 3 R's: rates, Russia, and recession. So just to stay on rates for a moment, how stubborn do you see inflation in the U.S.? But actually, since you're catering to global investors and global investments, inflation is raging in Europe too. How concerned are your investors about global inflation, not just U.S. inflation?
Well, our investors are very concerned about global holdings because most of our investors are global in the way that they are looking at putting their portfolios. And I think that's very prudent as an investor to be both diversified geographically and in some cases by asset class as well, right? And to Howard's point, the shift of what we're seeing right now means a shift in attitude around where investors are putting their dollars and where those opportunities are. And that comes back to my point of a real shift in a quote unquote sea change that we're seeing in fixed income at this moment, right? Because when you're seeing high single digit returns in a relatively safe asset class, you see that movement into fixed income opportunities in the near term. Now, having said that, we do expect and anticipate a couple more rate hikes ahead. As I said, probably some tapering. We'll probably see the ceiling there on rates at some point this year. We hope that we can skirt a recession. It could be a mild recession. But history shows us that we never hit a market bottom before a recession starts. And so therefore, if you're an equity investor and you're looking at the markets in the recent rally that we've seen in this last period, I would just be cautious because we think there's going to be a bit more volatility ahead. probably going to have to buckle down a bit here. But what's really important too is that you don't sit on the sidelines too long and miss out on the post-recession bear rally, which we've seen tends to be quite vigorous in the several years after. So, just difficult to time the market, to say the least. But I would say a few things that we're looking at for our global investors thematically, areas where we're really focused on opportunities in the long run in the next decade or so. One is really boosting our clients' portfolios with healthcare. When you think of the fact that a quarter of the world's population by 2050 will be over the age of 65, and the consumption needs around healthcare will be ever increasing. Couple that with the innovation that we're seeing in the healthcare industry around drug discovery, as we saw recently with the COVID pandemic, with telemedicine, with all the advancements that are happening in the healthcare space, on top of the fact that I also mentioned that some of the large pharma companies are also the best cash flowing, highest dividend paying companies, and it tends to be very counter-cyclical. So we like healthcare as a long-term industry and sort of an unstoppable trend area for our clients. I think on top of that, we really like certain aspects of digitization. So I have spoken with many CEOs around the world, and in their top three, inevitably, will be cyber. And the amount of dollars that continues to be invested into the cybersecurity industry is only going to increase. That coupled with opportunities like fintech, robotics, AI, all fueled by the brains of the digitization, which is semiconductors. So we think that those are some very unique opportunities as well. And then the third piece of it, I would say, is the greening of the world, the transition from fossil fuels to clean energy. So think, batteries, think clean energy technology, think, electric vehicles and the like. So we definitely think that there's a huge opportunity as the industry continues to shift and transition in clean energy as well. So those are just a few trends that we're spotting and putting into our investors' portfolios for longer term opportunities.
Right. No, and we can go into that a little more too. Howard, I do want to go back to you, and there's a question, several questions on your prognosis, which you don't like to do for the interest rates. I think it's important also to your point in your latest memo is that the interest rate environment now is actually the old normal, right? That it's not excessively high. You mentioned 20% that Volcker raised the rates to. There doesn't seem to be any indication that it will require that kind of intervention, but a number of our members of our audience are wondering what you think the range it might go up to, and whether or not that can engineer a soft landing that Ida referred to investors always want to see.
Well, there was a great investment sage called Peter Bernstein, and he wrote me once that that the market is not an accommodating machine. It will not give you appreciation because you want it. Similarly, the economy will not necessarily give investors what they want. The history, what is a soft landing? A soft landing is you have an economy which is too strong and consequently is producing inflation. You want to cool off the economy to cool off the inflation without producing a recession. In other words, if you want to put that in plain English, you want to get it exactly right.
Right.
Not so, your action should not be so limited that it doesn't fix the inflation, but it should not be so strong that it produces a recession. Just right. Hard to do. Given the imprecision involved in dealing with an economy, it's hard to guess that they're going to get it exactly right. And history suggests that soft landings are very hard to produce. Now, there's always a first time, and by the way, it wouldn't be the first time, but it could happen. But I would say the odds are against it. And if the so one alternative being talked up now, we talked about a soft landing. A hard landing is a recession that kills inflation but also kills the economy. Now people are talking about no landing, which is to say that inflation ebbs. The Fed concludes that it doesn't have to raise rates, thus there's no recession, and then inflation doesn't get eliminated, but it gets down to 3% or so, and the Fed says, yes, we can live with that. That's so anything's possible. It's a little bit Pollyanna, in my opinion. I think that the Fed is really going to be determined to get inflation down to its target of 2%. I don't have any inside information on that subject, but that's my guess, that they're going to try to get it to 2. They're going to do what it takes to get to 2. It's going to take at least the 2 interest rate increases that Ida talked about, that they're not going to work so fast. These things don't work instantaneously. And in addition to killing off inflation, you have to kill off inflationary expectations. Because as long as people think there's going to be inflation, then they want to buy today so that they can avoid buying tomorrow at higher prices, which strengthens the economy and ironically produces inflation. Inflationary psychology is self-fulfilling. So, look, I don't like it when the market is optimistic, frankly. Now, the market goes up the most when it's optimistic, but that's not what I'm interested in.
Right.
When the market is optimistic, there's room for disappointment. And when disappointment occurs, the market drops. So I don't like to participate in markets where there's optimism. And I believe that the sentiment that has been dominant for the last 10 weeks for that rally was optimism. So, you might say riding for a fall, if I'm right. I would rather see the optimism stripped out. Then there's no more room for disappointment. Then the surprises are on the upside. What causes optimism to be stripped out? Primarily losses. Ironically, when the stock is at 100, everybody thinks it's going up. But if it falls from 100 to 80, then people get worried that it's going to fall further. Of course, at 80, it's less risky than it was at 100. But most people act like it's more risky because it showed some weakness. But I'm talking my own book here. Since I'm a bargain hunter, I want to see things go down. Ida, who serves her clients, wants to see things go up. And there's the divergence.
Right. But you're also dealing in different markets, which is
right.
One is private and one is mostly public, but also private. Your clients have a lot of private. Well,
and the other thing is that Ida certainly has more equity investments than we do. We're mostly buyers of debt.
Right.
So buyers of debt are by nature not optimistic people.
So
if I was an optimist, I'd be in the equity market.
Right. So maybe being in the credit market all these years have made you a pessimist. But Ida.
Well, Howard, what did you think about my comments about shifting to private equity and hedge funds? Because our investors are really willing to pay that illiquidity premium in markets like this, right? And
yes, well,
you can find interesting valuation levels.
Mm-hmm.
So that's definitely part of the way that we're looking at the overall asset allocation as well.
At the right price, first of all, in my opinion, Ida, nobody needs their portfolio to be 100% liquid. Nobody's going to spend all their money in any given week or month, and nobody's going to transform their whole portfolio. So why do they need everything to be liquid? And so every investor should have, I like to think of it at kind of as layers, like geological strata. So every investor should have a bedrock which is liquid, maybe some assets which are semi-liquid, and then they can afford to hold some illiquid investments in the pursuit of higher returns. So I think that's absolutely right.
A negative rate of return sitting on cash over the
Yes,
last
that's right.
Well,
Of course, we don't have that anymore. But that's when I gave that speech about investing in a low return world. That was one of the prime elements. If you weren't fully invested, you had to invest regardless of the risk, because if you had money sitting on the sidelines, you got nothing on it. And most people will not voluntarily hold assets that produce zero return. So I'm entirely in favor of private investments. A lot of our investments are private in nature, or they're in funds that you can't get out of for 10 years, what we call closed-end funds. But that, of course, gives the manager the leeway to try to do something special to try to produce an outstanding long-term return. So we do a lot of that. I guess the only thing I would say is that if the last 13 years were, as I described, great for asset owners and great for borrowers, then by definition, for somebody who owned assets using borrowed money, it was a double bonanza.
Right.
And that is the definition of the private equity industry. And if I'm right in saying that in the years just ahead, assets may not appreciate as fast, and borrowing costs will not be going down, then I think it's less propitious for private equity. I mean, you couldn't, private equity was basically invented in '85, although KKR and Apax and Warburg Pincus started around '75, but it was basically popularized in around '85, and remember that the interest rate slide started in '80. So the private equity industry essentially has been living in a declining interest rate environment. So here's what happens if you're a private equity person. You study a company, you conclude that you can make a 10% return on that company. You ask your capital markets person, and she says, we can borrow the money at 8%. Well, you run out to borrow the money at 8% to invest it at 10%, and you make a great spread. Then when your debt matures, you go to your bankers and you say, we'd like to renew the loan. They say, okay, now the rate is 5%. And you say, boy, I'm smart. But so, it was really the best of times for private equity in particular. And if we are going through the sea change that I described, by definition, it will not work as well. It can still be a good performing strategy, but it can't do as well.
Ida, I'm going to kind of zoom out and talk about Asia a little bit now. You mentioned China reopening. It had been zero COVID last year. That had a lot of implications for the global economy. Now it is reopening, and a lot of people focus on the growth side, but it also has implications for inflation. How are you looking at the impact of China's reopening on the environment?
Yeah, since we are global investors, we have to consider all the different opportunities in the different economies around the world. And quite candidly speaking, we think that some of those opportunities may be greater in countries outside of the US in the coming years ahead. Why do I say that? Well, I look at China, and we look at the performance already since the bear market bottom for China. It's already gained 25% of the losses already. And when you think about the fact that China's had one of the highest savings rates over the last couple of years, I think that's something like 15 trillion yuan in savings. And you've got such a large consumption story there with the markets opening up there. And we think that's going to fuel a lot of the growth in the economy as consumers spend and as they start to travel and as they start to come out of a very lengthy lockup period. That coupled with the fact that we cannot ignore the second largest economy outside of the US is the G2, right? And as that bifurcation continues to happen, and as each of the countries start to be more self-reliant, you're still seeing a huge amount of innovation coming out of China, right? And everything from tech, AI, digitization, robot, you name it. So that can't be ignored in the long term as well. that decoupling of US and China represents a lot more opportunities for other countries as well that have knock-on effects, right? So you look at Brazil and China relationship, you look at Mexico-US trade relationship, you look at India. And a lot of countries in Southeast Asia are also going to be beneficiaries of this decoupling that's happening between the US and the China region. So just to say that if you're a long-term investor and you're long only one currency or one exposure, you're not, you're putting all your eggs in one basket. So you have to think about the longer term play here and adding geographic exposures and opportunities for growth in other regional exposures into our investors' portfolios as well. I give you another example. Latin America has outperformed most of the emerging markets, broader performance over the last 5 years. That's really driven by a lot of the natural resources that are in the region. You think about the fact that South America has something like 54% of the lithium reserves, right, in the region. And then you go back to my focus on clean energy and energy transition and everything that's happening there with the batteries. So there's a lot of interesting plays, I would say, in thinking about emerging exposures in the coming years ahead versus the developed markets like the US.
One question on China from one of our audience members is about they're interested in investing in China, but obviously they're concerned about the lack of transparency. And of course, that's been a big issue with Chinese firms listed in the US. Is there any sort of overall guidance from the private bank on not China, but also other markets that might have similar transparency issues?
Yeah, I think you have to go with a investment manager who knows the companies extremely well, that has boots on the ground, that has the diligence capabilities to put the right quality portfolio companies into your portfolios. And that's where we're very different because, as you said, Jonathan, we're the most global private bank in the world. We have boots on the ground in 52 cities in 20 countries around the world. We have diligence teams that know the companies that we're investing in on behalf of our clients really well. We're not flying people into diligence opportunities. We actually have been on the ground, for example, in Asia for over half of our existence, 120 years on the ground in the region with deep expertise. So I'd say that if you're going to navigate into investing directly in companies in certain regions or countries around the world, make sure that you're doing it with a firm that has the adequate diligence and proper knowledge of local rules, regulations, and the companies themselves and knows them very well.
Right. Howard, and actually this will be a question for both of you, but Howard, I'd like to get your take on it too, because obviously Oaktree has a very deliberate and refined investment strategy and process for that. But one of our audience members wants to know how what your views on AI and how that might impact investment strategy, if at all.
Okay, when I went to University of Chicago for grad school in the late 60s, Jonathan, my finance professor said that the average equity mutual fund doesn't perform as well as the S&P 500 and charges a substantial fee for the pleasure. So he says, why don't you just buy one share of every stock in the S&P 500? We didn't have the concept of index funds at the time or indexation. I was there in 67 to 9. Jack Bogle started Vanguard with the first commercial index fund in 1974. And it took a long time for the movement to gain momentum. But, by 15 years ago, I think more mutual fund equity capital was managed through indexation and passive investing than through active. Why? Not because indexation is so good, but because active management was so bad. Falling short of the index and charging a high fee was a very bad combination for the clients. So now we have most of the money run passively. And, I wrote a memo about 7-8 years ago called Investing Without People, which was on the subject. And, it talked about index and passive, then it talked about what we call systematic or algorithmic investing, and then it talked about AI and machine learning. And so if you realize that active management went out of fashion in equities because most active managers did a poor job, then it's kind of the writing is on the wall. And when you get into machine AI, I mean, what can a computer do? For the most part, what it can do is add, subtract, compare, remember, and process data. And it can process a lot of data, and it can do it fast without making any computational errors or emotional errors. That's a pretty good list. That's a simple list of qualities, but it's a pretty good list compared to the fact that most people can't do that. They can't process a lot of data really fast without making some mistakes, especially emotional.
Well,
the biggest mistakes in the market are emotional mistakes. So by that definition, then, a machine can outperform most people. And I believe, however, that there will still be room for a few people to outperform the machine. I hope to be one of them, and I hope Oaktree will be one of them. But how? And my perception is, not being a computer jock, that what the computer can do is all quantitative, and that a computer can't sit down with 5 business plans and figure out which one is the next Amazon, and it can't sit down with 5 CEOs and figure out which one is Steve Jobs, because it's qualitative, subjective, and future oriented. Now, I don't know if I'm right or not, but my hope is that there will be room for people in that equation. Now, let's be honest, most people didn't predict Amazon's success and didn't know to back Steve Jobs. So you still had to be superior investor in order to do those things. But I believe and hope that there will still be scope for the best investors.
Well, I think that Ida, as the head of a lot of a private bank with a lot of people running things and not machines, have technologies like AI been, it's very new, but how do you see that affecting how some of your financial advisors might work, or how your strategists might work?
So just to comment quickly on Howard's remarks on index versus active management.
Right.
Listen, we wouldn't exist as an industry or as a profession if we didn't feel that we had skill to drive alpha in and above an index. So I will say that, yes, I understand your perspective, but the whole reason why folks, work with us and that clients trust us to invest their monies is that we can prudently help them craft the right asset allocation and drive alpha in doing so, right? So not doing passive, but more active strategies all along the different trends that we're seeing, being proactive around that as well. But in terms of AI, I view AI as a huge complement to our industry as a whole. I think we're better with AI technology, everything from resonating with clients' feedback and conversations to helping us focus in on opportunities in a greater way. So using sort of AI technology to better gear our teams around the world to serve their clients based on clients' preferences. And that's one area that we're seeing AI make a huge impact already. Right, is the ability to know the client based on the trading patterns and what they're clicking on and what they're interested in, so that we're having more highly customized conversations with our clients. So we see it as being hugely additive, not only in the way that we speak to our clients about their personal preferences, but also in the way that we're looking at allocating some of their investments as well. So for now, we view it as a very positive addition.
An addition, obviously, not a replacement. So to talk about that allocation and going back to what you said about healthcare being one of these unstoppable trends, or aging, you mentioned that by 2050, I think a quarter of the world will be over 65. Correct. I think Asia is probably well ahead of that curve. I mean, certainly countries like Japan. So how is that impacting investment and in healthcare or other areas, specifically in that region?
So, Jonathan, the healthcare trend that I was speaking about is a global one. It's a global phenomenon. It's not just the U.S., and you're absolutely spot on to say that there is a huge aging demographic in the Asia-Pacific region as well, therefore driving further consumption and needs in healthcare too. So again, we do view that industry as a whole as being a very interesting and compelling one to consider complementing and adding into portfolios. Again, also because it's counter-cyclical. When you look at the performance of the healthcare industry last year, it was the second best performing industry after energy. So, there's definite benefits to having that diversification, but then also looking at areas and pockets that make sense for longer term investors as well.
Right. And crypto, you mentioned, cyber, you mentioned, which also kind of brings up the other digital asset, crypto. Howard, you I think talked a few years ago about how your son was the crypto expert in the family. So two questions. One does crypto count as a sea change or not yet? And how should people be thinking about crypto these days?
Well, I think, Jonathan, that crypto is a would-be sea change. But we have to see if it becomes one. I mean, if crypto is adopted in a serious way, then that would be a significant change in the way the financial system works. The jury is at best out on that subject. We'll see. I don't think crypto has had the advances that its fans hoped for. Bitcoin has probably been around for 13 years now, and I don't think it's, I don't perceive that it is in that broad a use. But people are still betting on its potential, and we'll see. I just don't know.
Ida, are you seeing interest? Waning interest, rising interest, no interest in crypto investments?
No, there was a period where there was a lot of interest in crypto, and I think that's waned off a bit, particularly in light of FTX and some of the lack of transparency,
right.
The non-correlation of the asset with any other asset classes, the lack of governance and oversight is very challenging. So from our perspective as a fiduciary for our clients, it's not an asset class that we would recommend, but some clients did have obviously some exposure to.
Having said that, Jonathan, my son bought Bitcoin when he was living with me during the pandemic, and I think he paid, let's say, $5,000, and today it's close to 24.
Right.
So he's up almost 5x in 3 years. He points out to me, I can't tell him he's wrong.
But I do think crypto assets is one thing, but I think the blockchain and the distributed ledger and that payment system is very valuable. Right. I mean, I'll put it that way, right? So let's distinctly separate the crypto asset from the technology that delivers the payments, which is going to be disruptive and continue to be, I think, a very interesting area.
Right.
We're approaching the end of the hour. I wanted to touch on one other geopolitical issue, the war. We're coming up on the first anniversary and hopefully one of the last of the war in Ukraine. And a couple big developments this week. Biden obviously visited Kyiv, and there seems to be building support among NATO for more advanced military aid. At the same time, we have the China-Russia relationship possibly tightening, and their visit by the foreign minister to Moscow today, and another visit by I think Xi Jinping coming up. How does that factor in? I mean, China's growing relationship and possible support for Russia. How does that, what impact does that have overall on the investment atmosphere either for China or in general, Ida? I mean, do you see the Russia equation continuing to weigh on markets throughout the year?
Well, listen, initially, we all felt that there needed to be another S in the ESG, and that was around security of energy and security of food. Okay, because of the consequence of the war, right? Because number one, that region's the largest exporter of corn and wheat, of potash, right? That fertilizes food around the world. And we thought there was going to be a much larger energy crisis in the region than there was, right? Because now you're looking at the Eurozone and you're saying, okay, well, it was a mild winter. It was very windy, and the energy issue is not as big as we thought it was going to be in the region, right? And we've also, I think, hit peak rates inflation in EMEA as well, in the Europe region. So I think, generally speaking, the relationship with Russia and China has always been there. I think that President Xi is looking at what's happening to Russia. With the sanctions and everything else that are happening there. And I think he's very much focused on what's happening immediately in his country with the reopening, with the COVID deaths and casualties that are happening there, particularly amidst this reopening. And I think he's being quite cautious, I would imagine, right? So in terms of any big geopolitical events that we're expecting from the region, we don't think there would be something terribly drastic happening in the near term. I think President Xi is very focused on what's happening immediately. He's got his hands full with what's happening in his country right now, especially with the opening.
Right. So you think perhaps that will drive some sort of moderate response, and he'll balance it, even though at least rhetorically there's a lot of movement toward Russia.
One would hope. One would hope.
Right, Howard. Other than the rates and the Fed, what are you looking at as another? Well, I'll ask both. What do you see as another cloud on the horizon that people might not be focused on, and conversely, what are possibly some silver linings that people aren't thinking about now because of all the raging headlines about rates and Russia?
Well, what is the biggest problem that is not highly rated in terms of importance? And I think it's the political division and dysfunction in our country. Right. And, I think, a lot of people were very concerned before the last election that people who don't believe in democracy were going to be counting we're going to be elected to positions where they counted the votes. It didn't happen, but I don't think the threat is gone. And we have serious problems in the country and the world that have to be solved. And in a divided government and in a Congress where both houses have these tiny majorities, I think that we're going to have bipartisan cooperation. And because we need it doesn't mean we're going to get it. And if we don't get it, we're in trouble. I mean, you look at Social Security. You have $20,000 in the bank. You make $1,000 a month, and your family spends $2,000 a month. You know exactly when you're going to go broke, and you don't do anything about it. You don't either earn more money or rein in your family spending. That's what's going on now in Social Security. And the two parties are having a contest to see which one can more emphatically say they're not going to do anything about Social Security. We know how that movie's going to end. So I think that's the biggest problem we face. It's kind of like the thing about interest rates. It's going to happen slowly and over a long period of time. But you can't say you don't know better. You can't say you don't know what the implications are.
Ida, just one final question to Howard's point about the division and the risks just within the American political system. We have all the posturing right now over the debt ceiling. Is that something that's concerning your clients?
Yeah, I mean, I think just to tack on to what Howard said, and I totally agree with him, by the way, that is a major concern, the U.S. political environment. But on top of that, too, I would say we must consider other potential geopolitical shocks around the world, and those are the black swan events that we all have to factor in. Right? I mean, I don't think anyone was expecting the Russia-Ukraine war to last as long as it has. And the question that many investors are speaking about is what happens next with China. Right? So what's going to happen with China-Taiwan relations? What's going to be down the pike there? So we have to be thoughtful around emerging geopolitical risks around the world, as well as with our U.S. political landscape as well. But I will leave you with the thoughts that for investors thinking about what to do. Fixed income right now, pivoting into some high quality dividend stocks, looking at adding some hedge fund private equity exposures, looking at industries such as healthcare, digitization, and clean energy. And then on top of all of that, making sure that you're thinking about geographical diversity. Mm-hmm. So not just looking at this US dollar and US centric portfolio, but looking at some opportunities in the emerging markets, as I mentioned, that may drive greater returns in the near term than the US market. So that's what I would leave investors with on this call.
That's great. Well, thank you. Ida, you got the first word. So Howard, you get the last word. Tell us what your next memo is going to be about.
Well, I'm working on one which is about, in the past, when I got market calls right, how did I do it? So that people can understand the process, and if I can draw something out that makes sense, that's what you'll see next, Jonathan.
That's great. Well, Ida and Howard, thank you so much for spending this hour with Asia Society. We will look forward to seeing you again in a year and holding you accountable to everything you said.
Well, it's a pleasure being on here with you, Jonathan, and with Ida. Thank you very much.
Thank you. Thank you very much.